Hello everyone, welcome to your Glassnode Week on Chain video report for week 2. I'm your host TXMC and I'm recording this on the 10th of January 2022. Coming into the beginning of this week, investors broadly were hopeful that fresh P&Ls to start the year would bring revitalized energy to markets. Well, that didn't quite play out as expected. Early in the week last week, the meeting minutes from December's Federal Open Market Committee meeting were released to the public, and markets reacted negatively to hawkish tones in those notes. Concerns of accelerated tapering of bond purchases, of the looming possibility of interest rate hikes, and the surprise appearance of quantitative tightening measures all sent markets reeling. After opening the week around 47,800, Bitcoin traded down as much as 15% in the red year to date, but ultimately closed near 40,600, which really put the bulls on the back foot to start the year. What we'll be unpacking today are a couple of dynamics related to this price action. The first will be investigating the behavior of older coin spending on chain. We'll seek to answer the question of whether HODLer conviction has been shaken by the ugly price action to begin the year. After we look at spending, we'll then pivot to the futures market, where open interest has continued to rise in the face of price weakness. We'll poke around in the derivative space. We'll also assess the possibility that a squeeze could be forming for bears that have continued chasing the market down with aggression. All of those things are coming up, so don't go anywhere. As we mentioned, price action coming into January was less than ideal. After medium-term investors spent heavily into the all-time high breaks in October and November, price action has failed to regain any momentum in the weeks following. An ugly liquidation event at the beginning of December really took the wind out of the sails for an end-of-year rally, as many expected, based on Bitcoin's past history. And so instead, December was treated to several weeks of ranging sideways crab market price action. And January's open was met with continued downside, and price is now seeking support at the midway point between the yearly range. And as we hover at this critical juncture in between the highs and lows of recent action, the conviction of hodlers will be tested, particularly investors who acquired their coins in this range, as Bitcoin's price now finds itself in the exact place it was a calendar year ago. Buyers of Bitcoin in the past calendar year are essentially break even, and the kind of uncertainty and ugly market behavior we've seen to start the year is enough to test the conviction of even the strongest minded investors. And one of the first metrics I want to look at today is the HODLer net position change. So this metric is showing the rolling 30-day change in coin maturation behavior. Each day that a Bitcoin sits dormant, held in an investor wallet, it accrues a single coin day. Upon the moment that that coin is spent for whatever purpose, all of the days it accrued to that point are destroyed. And that behavior helps to produce the suite of lifespan metrics we use to measure the markets. For HODLer net position change, positive values indicate that coin days are being accrued at a faster rate than they're being destroyed. Coin days being destroyed is analogous to spending. So when older hands decide to spend their coins in mass, we see large amounts of coin days being destroyed in bursts. A Bitcoin that was purchased 1 year ago and spent today would destroy 365 coin days. And the behavior we often see, particularly in bull market rallies, is the heavy spending of older coins as they seek liquidity into market strength, realizing profit to pay themselves for the long period of time that they sat patiently waiting and taking on risk. Investors ultimately want to pay themselves for the pain of waiting, and we see that behavior play out again and again in bull market runs for Bitcoin. Whenever new highs are made, older coins come to life. These moments of high spending can also occur in full market capitulations, when confidence is at its absolute lowest and market participants are seeking an exit at any cost. Those moments can also be catalyzed by high levels of older coin spending. Some of the dynamics we've observed in recent history are interesting and noteworthy. You can really see the heavy accumulation behavior that was going on in the depths of the July and June lows. Some of this spending here, as we rallied up into August, was catalyzed by a short squeeze in the futures market, which saw a number of older coins brought to life here in this small rally. We can even observe a burst of spending here in the middle of November after the second all-time high break. And we can tell that this behavior really started back here in September. You note the high here of HODLer net position change. It reached a high and began declining after the middle of September and declined all the way down into a period of net spending before reversing. So to me, this is showing a general distribution behavior on the way up to all-time highs. A decline in HODLer net position change from a period of accumulation down towards net spending just after the highs. But what have we seen in the weeks following? We have now reversed course and we are back into net accumulation. So the observation for this metric right now is that we got a level of spending at the highs. There was a bit of coin turnover that occurred up here at high prices, the kind of behavior we would expect, but the velocity of it was not comparable to the spring rally almost in any way. We barely broke out of net accumulation on a rolling 30-day basis, and it didn't come until after the all-time high. And the lows for this metric really didn't come in until after the all-time high. So while we did see some coin destruction here, we saw some net spending, there was enough accumulation going on that this metric did not print a heavy negative value, which tells us that a rush to the exits was not the climate of spenders here in the recent highs, not like it was in the rally to begin 2021. Part of this occurs because the highs that we achieved in 2021 came after multiple years of bear market. That builds up a lot of pressure and a lot of desire to exit by holders that have withstood many, many months and years of pain. These all-time highs in October and November came just 6 months after the previous rally. So it stands to reason that spender interest was not the same as it was a year ago. Another perspective of activity on chain is using the entity-adjusted dormancy flow. Dormancy is another way of viewing coin destruction. And when I say destruction, that is analogous to spending. It's the destruction of days accrued to a coin while it sat dormant. And when that coin is spent, all of those days are realized and destroyed. Dormancy counts the number of days spent per unit of BTC each day. So high values mean high levels of spending of older coin destruction, and low values of dormancy mean the opposite, mean hodling behavior, and younger coin activity being the predominant measure on chain. Dormancy flow is a metric created by David Puel, an OG on-chain analyst, and it creates a ratio between Bitcoin's market cap and the annualized dollar value of dormancy, of coin destruction, essentially the dollar total of all the coins spent in a given year. By creating a ratio between the market cap and the annualized dormancy value, you are in a sense creating a ratio between the asset valuation and the spender motivation. When you get high values for dormancy flow, it's a way of showing an equilibrium between asset valuation and spending behavior, and can assure you that the bull market is in healthy conditions. Likewise, when dormancy bottoms out, when it reaches a low, that could be perceived as a moment of peak value, when the market cap is low relative to the year value of spending. Those are historically cyclical lows, and they tend to mark periods of high value for Bitcoin entrants. It's worth mentioning that the version of dormancy flow we're looking at is entity adjusted. And entity adjusted means that our Glassnode algorithm performs a bit of smoothing on the data. It discards relay transactions and behaviors between investor wallets that we would not consider economically meaningful. Those get discarded, and we produce what we feel is a meaningful metric. And curiously, entity adjusted dormancy flow has now bottomed out for the first time since the low in July. If I break this metric out into its own chart here for you to see, bottom values for entity-adjusted dormancy flow are very infrequent, and they tend to occur at the absolute bottom of markets. Let's just go back through history and look. At every moment in Bitcoin's history where the absolute pico bottom for dormancy flow was reached, occurred at the absolute bottom for price. Here in 2011, in 2015, in 2018, in 2020, 2020, and then again in 2021 and now. Each of these prints has come many months or years separated from the previous, and it stands to reason that if this metric is assessing the market appropriately, we may be nearing a local bottom for seller interest. Now, it is possible for Dormancy to print even lower than the current value. It can go lower than this, but it's worth keeping an eye on when we zoom out and we see that Dormancy flow very rarely reaches these low levels, and it has historically marked a generational buying opportunity. This is something I am keen to watch in the coming days, and it corroborates some of the behavior we're seeing that shows that hodlers by and large are not spending here. So that's what we're seeing on entity-adjusted dormancy flow. Another metric of coin destruction that I want to point out is the 90-day coin days destroyed chart. So where dormancy creates an elegant ratio between the dollar value of yearly spending and the market cap, 90-day coin days destroyed is simply the rolling quarterly sum of coin destruction. No fancy ratios. And this is another metric I'm keen to break out and show you the bigger picture of. What historically plays out for Bitcoin is that periods of high interest in the market, for bullish or bearish reasons, result in high levels of coin destruction. If you look back through history, the 90-day rolling sum of coin days destroyed has peaked in bull markets and also at capitulation bottoms, like it did here in 2018. But most of the elevated events of destruction are in bull markets, and the most recent spike was in the beginning of 2021, when we finally broke over 40K and into the current price range. But curiously, the second half of 2021 failed to register a high value of coin destruction. And in fact, the all-time high breaks in October and November saw the absolute lowest totals of coin days destroyed in the history of Bitcoin's all-time high breaks. Every single moment in the past where price has broken over the previous high in a bull market has been at elevated levels of spending. Older coins by that point have already started to come to life. The market has found strength, price is ripping, and exit liquidity is not hard to find. In the second half of 2021, price was able to rally all the way back to new all-time highs despite a lack of retail demand, despite a lack of the kind of market strength that produces these rallies. That sort of fervor and casual interest in Bitcoin that really helps to drive price growth was not present in the most recent rally. What helped to drive price were some action in derivatives and largely a lack of spending by older coins. Simple supply and demand first principles would dictate that a lack of spending, even in a low demand environment, can lead to price growth. And that is what we got in a lot of ways near the end of last year. Yet, the amount of spending by older hands, while significant enough to cause price to roll over and lose steam, was not historically of the same level that it has been in past markets. So to kind of sum up what we're looking at in terms of coin activity, we've pulled back from the all-time highs in November. We've seen continued price weakness, some really ugly days in December, and then to start the year here in 2022. However, coin spending metrics are suggesting that we're nearing a local bottom, or at the very least, losing desire to spend at these levels. We're seeing accumulation behavior taking back the mantle of control, and these continued low prints of coin destruction and this very low value of dormancy flow suggests we are near a local low based on the historical prints of this metric. Where the action has really been taking place for Bitcoin is in the futures market. The futures open interest is a snapshot of all the open contracts in the futures market at a point in time. Shown here is the perpetual market, which is one half of futures. There's a side with the traditional futures market with expiring contracts, and then in crypto we have the perpetual exchange, where the continuous contract doesn't expire and the premium rate is governed by a funding mechanism. Following the dramatic liquidation on December 4th, open interest, particularly in the perpetual market, aggressively regained all of its lost Bitcoin and has now surpassed that level into all-time highs in Bitcoin terms. Open interest has shot up from a low of around 186,000 Bitcoin up to a high of around 264,000. Huge increase. and in Bitcoin terms has surpassed even the highs of mid-April when the futures market was at its raging highest. And to some degree, we're seeing a continual growth in futures. I think that as we move forward through time, we will continue setting new highs in total open interest month on month, quarter on quarter. But the interesting observation here is the incredibly quick recovery of open interest following the December 4th liquidation. Look at this aggressive return of interest to futures and the now surpassing of that level. And all of this playing out while price chops sideways and shows weakness. From a first principles understanding, negative price action will inherently close out long traders betting on price to go up. So for price to be declining while open interest is rising suggests short traders continually laying on bets into price weakness, doubling down on their expectation of continued weakness. Because if we were seeing aggressive longs piling in, their positions would continue to be closed as price goes against them. But as we're seeing the opposite behavior, it stands to reason that these are shorts and that they are building up a considerable amount of leverage. Here is futures open interest for the entire market. We're also including the expiring contracts in here. And what I would like to point out is the exchange really driving the growth in futures in recent times. So if I take off all of these other smaller exchanges, we'll see that the growth in futures has really come from Binance, particularly in the last few months. If I zoom in here, note Binance was heavily affected by the liquidation on December 4th. They are one of the largest exchanges, they have the most open interest, and their recovery following December 4th has truly led the market. They have recovered from a low of around 68,000 Bitcoin on their one exchange, all the way up to highs of around 117,000 Bitcoin, nearly doubling their reserves. This dynamic could be playing out for a couple of reasons. One is a speculative one, and it's hard to prove. But coming into the end of 2021, we know that China was forcing many exchanges to shut down their servicing of customers for crypto transactions. Huobi, OKX, and some other large Chinese exchanges were seeing users siphoned off all the way into the end of last year. If I show you here, this is Huobi and OKX, two exchanges that service a lot of Chinese customers, and their balance has been steadily declining in the last few months, at the same time that Binance has been growing. So one of the theories going is that Binance has been absorbing many of the traders that are being siphoned off of these other Chinese exchanges. But just in the last couple of weeks, Binance has seen an incredible rise in the amount of open interest in their futures market, faster than any other exchange. And they now own 30% of all open interest for Bitcoin as of right now. So over the next week or two, it's likely important to keep a close eye on the behavior of traders at Binance, as they are currently leading the market, and 3 of every $10 in futures currently lives on that exchange. And curiously, as we've been talking about the high levels of open interest, the actual amount of daily traded volume has been declining for the last few months. And the value seen here in January is equivalent to the lows of July. Now, it's important to distinguish between volume and open interest. Open interest is a snapshot of all of the open contracts at a moment in time. Volume is settled trading volume, is the closure of contracts in the exchanging of positions between traders. When price is sideways and there isn't a lot of movement, traders can get away with leaving their positions open, which allows daily settled volume to decline while open interest can remain high or continue rising. Because open interest are all of the contracts that have not yet closed and created a settled volume total. And it makes sense that as we've gone virtually sideways through the month of December, the moving average rate of daily volume for futures continued to decline, and at the current moment is essentially where it was in July. We've got a curious quieting of futures in terms of daily settled volume, while open interest, particularly in the perpetual market, is now reaching up to all-time highs. That says to me that there are a whole lot of traders waiting for price to force them to act. And based on this behavior, it looks like a fair amount of them are on the short side. And if we begin getting price movement in either direction, I expect we will see spikes in futures volume as many of these positions are forced to close. Here is a look at long liquidation's dominance. So this is a simple ratio between the total amount of long liquidations versus the total amount of short liquidations. So as a quick refresher, for longs to get liquidated, it means that they opened a futures contract betting on price to go up, price went against them, and their stop loss was triggered by the exchange, forcing an automatic closure of their position. Short liquidations occur in the same way for traders betting on price to go down. So when price goes against them, it means it's going up, and their positions are force closed. Those create short liquidations. While long liquidations do tend to be the dominant behavior. Bitcoin as an exponentially appreciating asset year over year, which also provides a number of leveraged products for people to express their bias against price, really creates a high volume of long liquidations throughout its history. But it goes in regimes. We have long periods of long liquidations, and then in bear periods, we have regimes of short traders dominating the pain. And an observation for me in the recent days is that the print of long liquidations dominance is the highest value it's been since the May crash, really showing a heavy bias towards longs getting squeezed, which makes sense. I mean, just look at the price action the past 2 months. It's been virtually straight down ever since the all-time high in early November. So we've got this regime of heavy liquidations to the long side, coupled with declining futures volume and increasing open interest. So there are a lot of traders allowed to hold positions open, not being forced to close them. Daily traded volume is declining into price weakness. It feels like we have a buildup of shorts piling in, layering on bets into price weakness, and that the long dominations chart could be setting up for a short-term reversal. It is important this week, as at all times in markets, to enter it with a framework of probabilities. As we've explored, older coin spending is at a minimum, and several of our lifespan metrics are printing values that suggest we are near a local low based on history. At the same time, we're seeing rising speculative interest in the futures market at all-time highs, and it has continued building in the face of price weakness and declining daily traded volume, which suggests a large number of short traders sitting on positions that have not been punished for taking on risk. If Wednesday's inflation report comes out more bearish than expected, the probability of this short squeeze scenario will likely not play out as expected, and we may see further downside, at which point it will be important to monitor those hodlers that we looked at earlier in the video. However, if we get even a modicum of positive price action, many of the shorts sitting on positions are likely to get punished. And if the relief rally begins, we will watch to see newer investors fight their way back into profitability, at which point spending behavior will again become key to watch. So as always, when you see price and you're wondering what is going on in the market, take a step back and assess the behavior of investors at scale. Dive into the data, look at spending behavior, look at hodling on chain, look at the rise of open interest in futures. This data is where we will find our edge. Thank you for watching our video today. I hope you found this assessment valuable. If you have any feedback or questions for us, make sure you leave them in the comments. We read through all of them. And we'll be back at it in a few days. Take care of yourselves, friends. We will talk again soon. Cheers.